Happy Friday, everyone. It's Shayan with Integrity Home Mortgage, back with your weekly rates rundown for Friday the 13th of March, 2026. I've been talking for months now about the fact that we have been enjoying the best rates in years. And my, how the turntables. I was traveling last week. I appreciate the day off. But today we're going to cover the last 2 weeks of activity in mortgage markets. So strap in because it's been a bumpy ride. Let's start by taking a look at the numbers, which have not been pretty. Since the last time we spoke 10-year Treasury yields are higher by a mind-boggling 31 basis points, up to 4.28%, and mortgage rates are worse by over 40 basis points since the beginning of March. The dramatic reversal in rates is no surprise, being driven by the escalating Middle East conflict. The fallout from the Iran war is impacting markets worldwide and has pushed oil prices up over $100 a barrel. Gas prices have risen over 50 cents a gallon. And it's caused serious supply chain disruptions, not just in oil, but also in things like fertilizers and petrochemicals, which are key inputs to so much of what is shipped or grown or manufactured worldwide. This military action has fundamentally altered market dynamics and really completely overwhelmed the disinflation, return to normal narrative that has been what's been driving rates lower for the past 5 months. Surprisingly, mortgage application activity was up slightly week over week, but that's really reflective of borrowers rushing out to lock in front of these rising rates. So look for refi activity to really fall off a cliff next week, just as purchase volumes begin to rise, hopefully. So what about data over the last 2 weeks? Well, both consumer prices, CPI, and core PCE, which is the Fed's favorite measure of inflation, both came in right in line with expectations, but still are elevated and moving in the wrong direction. PCE is now up over 3%, which is the highest it's been in about 2.5 years. And this reading comes in before oil was at $100 a barrel. Last week's non-farm payrolls was a big miss. The economy lost 92,000 jobs versus an expectation that it would have added 58,000. And the bulk of those losses came in private payrolls. The unemployment rate ticked up from 4.3 to 4.4%. And if you throw out the December unemployment number, which had some anomalies in it due to the government shutdown, this matches the highest unemployment rate since November of 2024, November 2021, when job markets were rapidly improving as they recovered from COVID lockdowns. And Q4 GDP revised down significantly to under 1%, which obviously is well below where current inflation sits. All of this is not painting a great picture for the economy. So don't be surprised when you start hearing people throwing around the S word once again. No, I don't mean that one. I'm talking about stagflation. February's data is showing higher inflation, falling growth, weakening jobs, and March is piling on with a crisis that is causing even more dramatic inflationary pressures and headwinds for growth. So it feels kind of trivial to talk about data when the world's most ubiquitous input cost is trading like a meme stock. But the next Fed meeting is right around the corner. And if there's one thing that Jay Powell has been consistent about, it's that the Fed is data dependent. So we got to talk about data. How do you set Fed policy when all the data you're using is pre this most recent war and is now obsolete? Military action has completely shifted market dynamics, and you're on the precipice of a changing of the guard at the Fed. Well, if markets are correct, the answer is you don't do anything for the time being. Futures markets are showing almost zero chance of a rate cut in either this upcoming meeting or the following one. And despite the president's vocal urging to do an emergency rate cut, which would be an absolute insane thing to do with such an historic stagflationary shock actively unfolding in markets, don't look for Powell to do anything prematurely here. The real change is going to be in the expectations for how a Kevin Ward led Fed might react. Before the first strike on Iran, there was an 80+% chance that the Fed would cut at least once by July. Now, the geopolitical shock and surge in oil prices has those odds down to less than 35% and dwindling from there. So the last 2 weeks will probably be remembered as the moment mortgage markets shifted from optimism to uncertainty as mortgage rates went from breaking below the psychologically important 6% level to basically erasing all the progress we've made since the beginning of September. So mortgage markets are at a bit of a crossroads. Wednesday's Fed meeting won't come with a policy change, but could provide some insight on how the Fed will be interpreting the impact of these shocks going forward. Like how they're looking at energy prices or energy impact on prices, right? Do they see that as transient or is that something that's in need of policy correction? Transaction volumes, like home sales, for example. If spring demand is light, how much of that is a factor of rates versus consumer sentiment versus additional job losses? And ultimately, how their outlook might change based on how long this conflict lasts and how far it escalates. I'm not naive. I don't expect we're going to get a ton of guidance on these points, so expect that markets will remain at a bit of a crossroads for some time now. And whether we follow a path towards lower rates or higher rates is really going to depend on factors well outside of mortgage markets, specifically geopolitical stability, energy prices, and Fed policy, which of course is a factor of inflation and jobs, and specifically in that order. That's all I got for you this week, folks. I hope to see you again next week. Have a great weekend.